Well, a major rate hike by the Federal Reserve today, raising the interest rate for the second time this year by 3/4 of a percentage point. The central bank trying to slash historic inflation while also avoiding a possible recession. So here's how today's interest rate hike will impact you. You'll notice changes with your credit cards, car loans, private student loans, and mortgage rates. Taking a look at credit cards, your card's annual percentage rate will likely increase within 1 or 2 billing cycles. Right now, the average annual percentage rate for a credit card is 17%, but that could be closer to 19% by the end of the year. Now, with car loans, the Fed's move could push up the average interest rate past 5%. That's according to Edmunds.com. New car buyers already paying $1,000 more per month. Those looking to buy a new home can expect to pay more interest in their new mortgage, with mortgage rates sitting at 5.5%. And as for private student loans, you could see an increase in interest charges within a month. But a reminder, those with federal student loans will not be affected because interest rates for those loans are set by Congress. Okay, joining us now to talk more about today's interest rate hike, NewsNation business contributor Lydia Moynihan. So, Lydia, we know that this latest hike, it's not unexpected, but is this the right move?
Well, happy hump day, happy Fed day. You know, the markets are a lot smarter than I am when it comes to that question, and they would indicate that they are very happy and that it certainly was the right move. And what we're hearing investors say is they finally feel like there is a light at the end of this very dark tunnel of inflation and rate hikes. And for the first time, Federal Reserve Chairman Jerome Powell signaled that he can maybe slow how quickly he's raising rates. And that was very good news for the markets because it means that this record inflation we're seeing of 9.1% last year, that's likely in the rearview mirror. And these dramatic rate hikes are likely in the rearview mirror as well.
All right, so we saw the results there. Good news for the markets. Again, another 3/4 of a percentage point. We kind of went through what it could mean when it comes to mortgages, credit cards, that kind of thing. But what does this really mean for the average borrower?
Yeah, well, you touched on, obviously, those interest payments are going to be going up. But I think it's important to note, obviously, it affects consumers, but that has a cooling effect across the economy. So if you're a small business owner or a big business owner, you might be less inclined to take out a loan to invest in building a new factory or what have you, right? And so we're going to see that cooling not just at the individual level, but really across the economy as a whole. And if you're a saver and you have money in the bank, good for you. And you will likely see eventually your interest on what you have in the bank go up as well.
Well, that's some good news there. Lydia, we talked about
the rich
how the
get
markets,
richer.
Right. Well, yeah. Well, maybe that's not such a good thing. We were talking about the markets there. We did see that before this announcement, the markets were up this morning. They went higher after that. Does that mean investors agree with this decision?
I mean, I think absolutely. And again, what they really were looking at is not just what Federal Reserve Chair Powell did, because everyone was expecting that we were going to see the 75 basis point hike, but what he was saying about the next sort of couple years in the economy. And he set a pretty optimistic tone that it seems like inflation may have peaked. He said it's going to be appropriate, likely to slow the pace of increases. So that means that they're likely getting the situation under control and that they may be able to find this sort of soft landing where you rein in inflation and avoid going into recession. He also just emphasized it's a strong labor market, and he thinks that we're not in a recession right now. And of course, these comments come just the day before we get the second quarter GDP report, and that's going to be a big deal because the definition of a recession is 2/4 of the GDP shrinking. Last quarter, we saw shrinkage. So if we get that report tomorrow and the economy has shrunk, that means we're in a recession. But Jerome Powell doesn't think we are right now. So,
a lot of people certainly waiting to see what we learn tomorrow. So yet another interest rate hike. Two questions for you. How historic of a move is this, to have yet another one? And do you think that we can potentially see even more rate hikes before the year's over?
Well, it's interesting. The rate at which they're raising rates is pretty historic. The last time we saw a 75 basis point hike was 1994, and then we saw it last month and this month. So that's pretty dramatic. But where we are in terms of interest rates is still relatively low. It's only about 2.25 to 2.5%. Those are the interest rates we had pre-COVID. And you look at less than a decade ago, we had interest rates of 5%. In the 80s, we had interest rates of close to 20%. So historically, we're still actually relatively low when it comes to interest rates. But again, it's been a pretty rapid pace the last 2 months of raising those rates.
All right, Lydia Moynihan, thank you. Thank you for watching. Go to newsnationnow.com to find News Nation on your television provider. And don't forget to click the red subscribe button below to get more of News Nation's fact-driven, unbiased coverage.